Ladies and gentlemen, depending on where you are in the world, today I want to talk to you about something profound, something that in my judgment could reshape a critical corner of the global financial system, the silver market. We all know the story of debt, money, and cycles. But what if I told you that right now, in 2025, there is a force building in silver that isn't just about price, it's about structural, systemic transformation. Something massive is about to shake the silver market, and not just for a few speculators, but for the very architecture of wealth itself. We live in a world governed by cycles, and the most powerful of these is the debt cycle. Over time, societies accumulate debt, sometimes prudently, sometimes recklessly, and the consequences of that accumulation shape everything from markets to social stability. Debt is a tool, a mechanism that allows growth, expansion, and opportunity, but like all tools, it can be misused. When debt grows faster than the economy's capacity to service it, when borrowing outpaces productive output, an imbalance is created. This imbalance is not theoretical. It manifests in tangible ways: rising inflation, diminished purchasing power, and strained financial systems. When we examine history, we see a clear pattern. Long periods of debt accumulation are often followed by periods of deleveraging, where debts are reduced either through defaults, restructuring, or inflationary erosion. These cycles repeat, and while the timing and triggers differ, the underlying mechanism remains consistent. Today, the global economy is at a point where the accumulation of debt has reached unprecedented levels. Governments, corporations, and individuals have borrowed heavily, often under conditions of low interest rates and easy monetary policies. This borrowing has fueled growth, but it has also created vulnerabilities, structural weaknesses that cannot be ignored. As debt grows, the cost of servicing it begins to consume more and more of income streams. Resources that could be allocated to productive investment are instead diverted to paying interest. At some point, the capacity to sustain this debt falters, and stress accumulates in the system. When stress reaches critical levels, it can trigger a chain reaction, a correction, a collapse, or a significant market adjustment. The timing of such events is difficult to predict precisely, but their inevitability is grounded in the laws of economics and human behavior. The consequences are rarely confined to one sector. They ripple outward, affecting currencies, asset prices, and ultimately, the real economy. The behavior of central banks and monetary authorities adds another layer of complexity. When debt becomes excessive, policymakers often attempt to mitigate the consequences through monetary expansion, lowering interest rates, printing money, or implementing stimulus programs. These actions may provide temporary relief and stabilize markets in the short term, but they also delay the necessary adjustments. The result is a prolonged period of imbalance, where underlying weaknesses grow even as apparent stability is maintained. This is the paradox of modern financial systems. The mechanisms designed to prevent collapse can, over time, create conditions that make collapse more severe when it finally occurs. A critical feature of debt cycles is human psychology. Optimism during periods of growth encourages borrowing and risk-taking. Confidence fuels expansion, and the positive feedback loop between borrowing and economic activity can make the system appear robust. Yet, as imbalances deepen, reality eventually asserts itself. Confidence falters, risk aversion rises, and what once seemed sustainable becomes precarious. Markets react, sometimes abruptly, and the transition from optimism to pessimism can be swift and severe. Those who fail to recognize the cycle often suffer the greatest losses, while those who anticipate it can navigate turbulence with foresight and resilience. In this context, tangible assets such as commodities, precious metals, and certain forms of real estate take on a different significance. They are not immune to the cycle, but they provide a store of value when fiat systems or debt-laden instruments falter. Their role becomes particularly pronounced when currency values are pressured by excessive borrowing, as inflation erodes purchasing power and financial claims on paper lose real world backing. The lesson is that in a world dominated by cycles, diversification and a balanced approach to risk are not optional. They are essential. Recognizing where we are in the cycle, understanding the mechanisms that drive it, and preparing for multiple scenarios is far more important than attempting to predict the exact timing of the next market move. Finally, the magnitude of global debt today underscores a fundamental truth. Systems do not adjust gradually when imbalances are extreme. Small corrections are often insufficient. Large, sometimes disruptive adjustments become unavoidable. Understanding the scale of these imbalances allows for strategic decision making. It allows one to distinguish between transient volatility and structural shifts, between noise and signal. It allows for positioning that is not based on hope or speculation, but on principles grounded in observation, history, and the dynamics of debt. The cycle does not bend for anyone, yet those who study its patterns and prepare accordingly can navigate uncertainty with confidence, turning potential risk into opportunity and ensuring resilience in the face of inevitable change. In times of economic uncertainty, the concept of value takes on a different meaning. Money, in its conventional form, is a claim on resources, a representation of wealth. Yet, when the systems that back money are under stress, the purchasing power of currency can erode, sometimes gradually, sometimes rapidly. This is why the idea of a store of value becomes critical. A store of value is an asset that retains worth over time, independent of fluctuations in fiat currencies or the broader financial system. Its role is not to generate speculative gains in the short term, but to preserve real wealth in the face of systemic pressures. This is a principle that has been tested repeatedly throughout history across different civilizations and monetary systems. Inflation, at its core, is a reduction in the real value of money. It occurs when the supply of money grows faster than the underlying productive capacity of the economy, or when debt obligations outpace economic output. The consequences of unchecked inflation are far-reaching. Savings that are held in currency lose purchasing power, wages may lag behind rising prices, and financial instruments denominated in that currency can underperform relative to real needs. For individuals, corporations, and nations, the impact is not theoretical, it is tangible. Everyday goods, housing, and basic necessities can cost more in nominal terms, and the security that people assume they have in their wealth can erode if they are overly reliant on fiat money. In this environment, tangible assets become essential tools for wealth preservation. Precious metals, commodities, and certain forms of real estate serve as stores of value because they are scarce, durable, and widely recognized. Unlike paper currency, which is a liability of a central authority and can be devalued at will, these assets have intrinsic characteristics that make them resilient to monetary expansion. Their value does not rest solely on the confidence of policymakers or the credibility of a government. It rests on a combination of scarcity, utility, and historical precedent. For investors seeking stability in volatile times, understanding these qualities is crucial. Silver, in particular, occupies a unique position. It is both a commodity and a monetary asset, bridging the gap between industrial utility and wealth preservation. Its dual role amplifies its importance in a diversified portfolio. When inflation rises or currencies are pressured, silver's monetary characteristics become prominent, acting as a hedge against the erosion of purchasing power. When industrial demand grows, as it does with technological advances and green energy initiatives, silver's scarcity supports its intrinsic value. This combination of factors creates a dynamic where silver is not merely a hedge, but a strategic asset that can provide protection against multiple forms of risk. The principles underlying this strategy are rooted in observation and history. Throughout time, societies have experienced periods where fiat currency became unreliable. Those who held real, tangible assets maintained their wealth, while those overly concentrated in paper claims often suffered. This is not speculation. It is a recognition of cause and effect within complex systems. Economic pressures, such as debt accumulation and currency debasement, create conditions where certain assets outperform simply because they preserve value when others do not. Diversification into these assets is therefore a rational response, a calculated approach to managing uncertainty rather than a gamble on price movements. Importantly, the use of assets as a store of value is not a static strategy. It requires ongoing assessment of the broader economic environment. Inflation trends, monetary policy decisions, global debt levels, and technological shifts all influence the relative effectiveness of various assets as hedges. Maintaining resilience involves balancing allocations, understanding correlations, and recognizing when external pressures are likely to affect purchasing power. It is a process of continuous evaluation, of anticipating potential imbalances, and of positioning in a way that safeguards real wealth without overexposure to any single risk. Finally, the broader lesson is that preserving wealth in an inflationary environment is less about timing the market than about understanding the mechanisms that drive value. Real assets, by virtue of their scarcity and utility, provide a hedge against the erosion of currency. They act as an anchor in a sea of financial volatility. In times when trust in paper money may falter, these assets maintain purchasing power, offering security and stability. The wisdom lies in recognizing their role early, integrating them thoughtfully into a diversified approach, and understanding that they serve a fundamental purpose: protection against forces that are often beyond individual control. The goal is not speculation, but preservation, not opportunism, but prudence. By focusing on assets that reliably retain value, one can navigate the uncertainty of inflationary pressures and maintain wealth through cycles that challenge conventional monetary systems. Markets are governed by fundamental forces, and among the most powerful of these is the interplay between supply and demand. This principle may seem simple on the surface, but its effects are profound, particularly when applied to critical resources such as silver. Silver is not merely a commodity, it is both an industrial input and a store of wealth. This dual role creates a dynamic where shifts in either supply or demand can have significant, sometimes disproportionate, effects on its value. Understanding this interplay requires careful observation of global economic trends, industrial innovation, and the limitations inherent in production. On the supply side, silver is constrained by the nature of its production. Unlike paper money, which can be issued without physical limits, silver must be extracted, refined, and delivered. Much of the world's silver is obtained as a byproduct of mining other metals, such as copper, lead, and zinc. This dependency means that even as demand increases, production cannot always be scaled proportionally. Mining expansion is costly, time-consuming, and subject to environmental, regulatory, and geopolitical constraints. The result is that supply grows slowly and often unpredictably, creating a structural tension between what is available and what the market requires. When demand outpaces this constrained supply, pressure builds and the market adjusts, often sharply. On the demand side, silver's role is expanding. It is a critical component in technology, solar energy, electronics, and other industrial applications. These sectors are experiencing accelerated growth due to global initiatives, technological adoption, and shifts toward renewable energy. Industrial consumption is not merely cyclical, it is structural. As technology evolves and new applications emerge, the baseline demand for silver rises in a way that is independent of short-term market sentiment or speculative activity. This creates a scenario where demand growth is steady, persistent, and increasingly decoupled from conventional economic cycles, while supply remains relatively rigid. The combination of constrained supply and structurally growing demand produces a fundamental imbalance. Markets do not require speculation to create upward pressure on prices. The simple mechanics of scarcity and necessity are sufficient. When the forces of scarcity intersect with critical industrial requirements, even small changes in production or consumption can have outsized impacts. Historical examples demonstrate that markets experiencing such structural imbalances often see prolonged periods of price adjustment, where assets are revalued to reflect their true scarcity and utility. These adjustments are not random. They follow a predictable logic rooted in supply-demand dynamics. Beyond the basic mechanics, human behavior amplifies the effects of structural imbalances. When market participants recognize scarcity and increasing demand, they respond by accumulating, hedging, or reallocating resources. This collective behavior further tightens availability and reinforces upward pressure on value. In silver's case, its dual role as both an industrial necessity and a store of value means that it is affected not only by production and consumption, but also by perceptions of risk, opportunity, and systemic security. The market, therefore, reacts both to tangible constraints and to the expectations of participants who anticipate those constraints. Geopolitical and environmental factors also influence the supply and dynamic. Mining operations are concentrated in certain regions, subject to political regulation, labor challenges, and environmental policies. Natural disruptions, policy shifts, or trade restrictions can create sudden supply shocks, intensifying existing pressures. On the demand side, global technological trends and energy transitions continue to accelerate silver consumption. These forces operate independently yet simultaneously, producing a compound effect that strengthens the structural imbalance over time. The interplay between physical scarcity, industrial necessity, and strategic accumulation creates conditions that are often underappreciated until they manifest in significant price movements. Finally, understanding this structural shift requires a long-term perspective. Short-term volatility can obscure the underlying mechanisms, leading observers to mistake noise for trend. Yet the forces shaping silver's supply and demand are not ephemeral. They are persistent, measurable, and grounded in real-world constraints. The alignment of constrained supply, rising industrial demand, and strategic accumulation creates a framework in which silver's value is increasingly dictated by fundamental pressures rather than speculation alone. Recognizing this, positioning oneself strategically, and maintaining awareness of both production limitations and demand trajectories allows for informed decision making. It is not about chasing immediate gains, but about appreciating the structural realities that govern the market and preparing for the implications of enduring imbalances. In investing, there is a fundamental truth that applies across all markets and all periods. Risk is inevitable and uncertainty is constant. No individual, institution, or system can predict the future with certainty, nor can anyone control all the variables that influence outcomes. Because of this, the most important principle is not attempting to avoid risk entirely, but to understand it, measure it, and manage it thoughtfully. Risk management is the cornerstone of long-term success, and diversification is one of the most powerful tools available for achieving it. Diversification is not merely spreading assets randomly. It is a deliberate allocation across different types of investments, markets, and instruments, structured to reduce exposure to any single source of loss. The mechanics of diversification are straightforward in concept but nuanced in practice. A diversified portfolio contains assets that do not move in perfect correlation with one another. When one asset class experiences a downturn, others may hold steady or even increase in value, thereby reducing the overall volatility of the portfolio. This is not a guarantee of gains, but it is a strategy to preserve capital, protect purchasing power, and maintain optionality in the face of uncertainty. Effective diversification requires analyzing correlations, understanding how different markets interact, and anticipating how systemic events might impact various holdings. It is a proactive approach, not a reactive one. In the context of precious metals, silver and gold play a distinctive role in diversification. They are not dependent on the credit worthiness of institutions or the solvency of governments. Their value is derived from scarcity, utility, and historical precedent as stores of wealth. When traditional financial assets, such as stocks or bonds, are under pressure from inflation, currency devaluation, or systemic shocks, precious metals often act as a stabilizing counterbalance. Their inclusion in a portfolio is a recognition that risks in modern economies are multidimensional, and that exposure to paper assets alone can leave one vulnerable to forces beyond immediate control. Risk management also requires acknowledging that financial systems are complex and interconnected. An event in one sector or region can cascade into others, amplifying effects in ways that are not always intuitive. Leverage, debt, and concentration in specific asset classes increase vulnerability. By diversifying, an investor reduces dependency on any single outcome and creates resilience against shocks. This does not mean eliminating risk. Doing so is impossible, but it does mean positioning oneself so that potential losses are manageable and do not threaten long-term objectives. Diversification is a strategy for survival, and survival is the prerequisite for capturing opportunity when it arises. Timing and discipline are integral to this approach. It is not enough to simply hold a mix of assets. One must continually reassess exposure, market conditions, and correlations. Economic environments evolve, and what provides protection in one cycle may be less effective in another. A disciplined investor monitors these shifts, adjusts allocations prudently, and maintains flexibility to respond to emerging risks. This ongoing management is what differentiates a thoughtful, principled strategy from reactive, speculative behavior. Consistency in adhering to diversification principles rather than chasing short-term trends compounds advantages over time. Furthermore, diversification intersects with the principle of understanding the underlying mechanisms that drive markets. Assets are affected by different forces. Some are sensitive to interest rates, others to industrial demand, geopolitical events, or inflationary pressures. Recognizing these mechanisms allows an investor to balance exposure strategically. For example, holding silver is not only a hedge against inflation, but also a response to structural industrial demand. Holding bonds provides income and stability, but exposes one to interest rate risk. By combining assets that respond differently to economic forces, one creates a portfolio that is robust under multiple scenarios, reducing the likelihood of catastrophic losses. Psychology also plays a critical role in risk management. Fear and greed can drive behavior that undermines diversification, such as overconcentration in winning assets or panic selling during downturns. A principled approach involves recognizing these tendencies and implementing structures that enforce discipline. This may include predefined allocation ranges, periodic rebalancing, and scenario analysis. The goal is not to eliminate emotions, but to manage them in a way that aligns behavior with long-term objectives. Rational, systematic decision-making provides a framework to navigate uncertainty while maintaining focus on preserving and growing wealth. Ultimately, diversification and risk management are about preparedness. The future is inherently unpredictable, and the costs of being unprepared can be substantial. By thoughtfully allocating across uncorrelated assets, understanding systemic vulnerabilities, and maintaining discipline in monitoring and adjusting portfolios, an investor positions themselves to withstand shocks and capitalize on opportunities as they arise. This is the essence of resilient investing, recognizing that risk cannot be avoided, but it can be understood, managed, and leveraged to achieve sustainable results over time. It is through this disciplined, principle-driven approach that one can navigate the complexity of modern financial systems, protect real wealth, and thrive across cycles that test both markets and human behavior. In closing, let me say this: financial markets are not random, and change does not happen in isolation. The forces at work in silver today echo the deep, timeless patterns that I've studied in history, debt cycles, currency cycles, and human behavior. We stand at the brink of something profound. If you are wise, you will not treat silver as a speculative rocket. You will treat it as part of your insurance against the systemic risks that many prefer to ignore. And if you are bold, you will recognize that in this transformation lies opportunity,